Welcome back. Here with us on Trading Hour, and as promised, let's get to that thematic discussion with Karan Taurani of Elara Securities. He's come out with a note talking about the expectations that we can have from consumer discretionary companies in the fourth quarter, and Karan has bucketed them into three categories: alcoholic beverages, AlcoBev, the QSR space, and also beauty and personal care. I mean, quick commerce, something like Nykaa. Karan, great to have you on the show. Thank you very much for joining in. So let's start first with, your overall trends, because the whole narrative in the market has been that discretionary consumption has been doing much better. The analysts who track staples anyway are telling us don't expect anything big by way of volumes or even a recovery. So on discretionary in general, are you expecting any pleasant surprises tucked in anywhere?
Hi, Surabhi. Pleasure to be here. So I think on the discretionary side, definitely, volume growth has been slightly better, but it really depends in terms of what segments are we talking about. So in the case of beer, I think we see strong volume growth for UBL, close to about 8-10%. On the AlcoBev side of the spirits, which is United Spirits, the Prestige and above will grow by about 3-4%. Radico on Prestige and above volumes will grow by about 14 to 15%. So I think selectively volume growth has been very strong for the AlcoBev segment versus last year. If you look at QSR, I think there's a problem. I think all the companies are going to report an SSG decline in the range of about 3% to 15%, wherein pizza category, specifically Pizza Hut, will be at the higher end of this band. And if you look at fried chicken, they'll see a decline of about 2 to 3% odd. So I think fried chicken will see some kind of outperformance versus the pizza category. As far as Nykaa is concerned, because the company is online, I think the BPC category growth is about 25 to 28%, which is also strong. So I think it's a mixed bag. I think except QSRs, if you look at online BPC and if you look at AlcoBev, I think there's strong volume growth in this quarter.
While QSR is weak, quick commerce is booming. Blinkit's numbers are only getting up, and that's pushing up the valuation for Zomato. Talk to us about Zomato, because it's, when you speak to people outside, they're saying the total addressable market for Blinkit, and that's going to be the value driver for Zomato going ahead, is so wide. Like today, they're doing, some groceries, some essential goods here and there, but they can take on an Amazon and Flipkart. So talk to us about Zomato and how you see this over the longer term.
So I think the quick commerce space has been quite exciting. I think what we've seen in the last 6 quarters is very superior execution by Blinkit. Everything, in terms of higher orders per store, which is higher throughput. Also in terms of, cost rationalization, also in terms of multiple margin levers. So margin levers, they've got 2 levers. One very big lever that they have is product mix change. So they're trying to focus more on PPC product, other retail products, which are high margin nature. Even apparel for that matter is something what they've started very recently. And second, of course, is advertising revenue. So Blinkit as a platform can cater to a wide range of advertisers as compared to Zomato, which would appeal only to food business advertisers. So that's another very big lever as far as profitability is concerned. I think they are potentially on track to get a break-even by about Q1 FY25. So I think basis execution, Blinkit valuations, have been moving up. And to your question in terms of the addressable market, so I think quick commerce market is only about 2% of India's e-commerce market. Potentially with the kind of growth and offtake that we've seen right now, it can move to almost about 4% of India's e-commerce market over the next 2 to 3 years, because there's a strong potential for about 70-80% CAGR growth in this segment. Also, one more interesting thing in this segment is that many of the companies have also tried loyalty programs, and loyalty programs will lead to better AOV as well. So, if you look at the grocery segment or the FMCG segment or the staple segment rather, the contribution on quick commerce platforms from this category was about 80-90%, which has now come down because beauty, personal care, and apparel and other non-food segments are also doing well over here.
I just want to go back to that point that you made on QSRs, Karan, and that pain has been ongoing for several quarters now. And if I heard you right, you were saying that same-store sales could decline by anywhere between 3% to 14% for the players this time around. So, any light at the end of the tunnel? And a related question, that because the going has been so difficult, obviously stocks haven't gone anywhere. Is this the time to try and bottom fish? Or do you think it's still, difficult out there and you'd better be off in other consumer stocks?
I think they're selectively positive on the QSR side. As we said, we have a positive stance on companies like Devyani and Sapphire. because 80 to 90% of these companies' valuations are driven by KFC. So we believe that in terms of potential recovery, in terms of potential growth rate, both in terms of SCG and in terms of store addition, you will see better growth for KFC, and which will have a benefit for Devyani and Sapphire. So we are certainly positive on those names. I think pizza as a category, or rather burger as a category, there are still concerns. The market is quite fragmented. The competitive intensity is only increasing. Especially, for pizza, their major clout in the pre-COVID times was delivery. Which now stands to be disrupted. Right now, it's kind of democratic. Anybody can just open a pizza chain and piggyback on Zomato and have good delivery volumes in terms of their revenue. So I'm saying the pizza space, unless we don't see competitive intensity cooling off, I don't see any respite over there. Burger as a category is somewhere between fried chicken and pizza, but burger again is seeing competitive intensity with new players coming in. So a lot of offtake has happened from cloud operators, new players. 2-3 things have happened here. Even the customers have kind of adopted to new players. Customers are open to trying out. Customers are willing to try out products from these new players, which was not the case earlier 4 years ago. So my point is that global QSR chains, except for the fried chicken category, are under pressure because of heavy competitive intensity.
So you like Devyani and Sapphire. What is your target price, and how do the valuations stack up for these compared to what we've seen, say, a year ago or 3 years ago?
So typically, why we like Devyani and Sapphire, because both these companies, firstly in terms of SSG, they could report an outperformance versus pizza category, and this outperformance is a big one. It could be almost about 2 to 3% higher growth on SSG versus pizza as a category. The second thing is store growth. So pizza as a category would have store growth of about 8-9%. Because fried chicken is underpenetrated in India, there's a big opportunity over there for fried chicken to expand. You could see store growth of 10 to 15% for this category. The third thing is profitability. So if you look at Jubilant for that matter, of lately they've announced free delivery on their app, and that will impose margin pressure. Plus, pizza as a category is investing very aggressively in terms of value offers and promotions and everything put together, which is kind of diluting the margins. So even from profitability standpoint, I think they are right now on par with Jubilant, and probably could emerge higher from here on because of the growth in the category that they're seeing. So putting all these things into perspective, we believe that this company could trade at a 25-30% premium versus Jubilant or the pizza category as such. So we've given a target EV/EBITDA multiple of about 38 to 40 times for both these companies, as compared to Jubilant, which is around 31 times target EV/EBITDA F26.
So pizza is not that hot. Maybe fried chicken is better off from an investor standpoint. Just to dial back to Alco Beverages, where we started, Karan, you said that the beer category is seeing the best growth. I think 8 to 10% for UB, you said. Now, again, just from a risk-reward basis in terms of picking stocks, how do you see USL? What about Radico? Just give us some sense on also margin trends, what we can expect. I think you're expecting some margin compression for a lot of AlcoBev companies as well. So, just what we can expect and your topics here.
Right. So from a growth standpoint, I think UBL is been the most aggressive. I think, with the new CEO joining, they have gained market share in some markets in the North India. They had lost market share in the Kingfisher category, which is the regular beer category, until about a year back. And they have seen pressure from local players like Soam in certain selective markets. So that issue seems to be arrested. So versus last year's base, you will see market share gain and better volume growth for UBL. As far as UNSP and Radico is concerned, I think UNSP volume growth is slightly muted, about 4 to 5%, unless we don't see, this volume growth moving towards 7 to 8% or probably outperforming industry averages. You will not see de-rating on the stock because the stock is at about 53, 54 times core AlcoBev business. So we don't like UNSP in this space, but yes, UBL is a momentum play. But UBL, I think, again, at these valuations, it is fair. I don't find the valuations to be attractive because margin is a big issue here. They are investing aggressively in the beer category, investing aggressively in terms of expanding market share in the premium beer, which is Heineken. So I think basis that you'll see margin pressure, and margins are at a big gap versus pre-COVID levels. Pre-COVID EBITDA was about 14-15%. They're at about 8-9% EBITDA. So I think unless we don't see that recovery on EBITDA margin, we won't see upgrades as far as UBL is concerned. So selectively, I think we prefer Radico the most here. Again, the valuations are not very cheap or attractive, but this is a very good compounding story wherein you can have 15 to 17% volume growth, 20 plus percent revenue growth in the P&A category, and overall revenue growth of 15% plus with an improvement in margins because Radico has also done backward integration and they are somewhere protected with this higher E&A cost. So I think gross margin wise, or rather commodity wise, QSR companies, AlcoBev companies, all of them are seeing some kind of a respite, but not all of them will see expansion or EBITDA margin because most of the companies are investing in terms of promotion, sales, marketing, and in discounts and value offers.
Got it. Fair enough. That's the takeaway. Watch out for perhaps decent volume growth on the AlcoBev side. QSR, the pain is continuing. That's the verdict coming through. Karan, thank you very much. Very helpful discussion as we gear up for earnings. Thanks for joining us on the show today. We'll take a break on that note, come back on the other side, and we will, of course, get you more on the markets. Also, we have an announcement to share with you. We are launching CNBC-TV18's first ever live personal finance webinar, CNBC-TV18 Accelerate, a personal finance handbook with Sonia. She will be joined by 3 well-known experts on Saturday, the 11th of May, 9 a.m. onwards. We'll be diving into everything you need to know to master your finances and learn how to grow your wealth, insurance, tax saving, managing your portfolio, retirement planning. There's lots to learn. Whether you're in your 20s, 30s or 40s, this live webinar is for you. We have limited seats, so don't miss this chance to register now. Scan the QR code to register or log on to cnbctv18.com.